before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice. Welcome back to the Loonie Hour, episode 10. As always, we're back in the saddle here. We've got the popular, everyone's favorite boomer, Keith Dicker of IceCap Asset Management, wearing his Christmas sweater for us this week. And of course, we've got the Tom Brady of macro, Rich Diaz, currently in London. Welcome back to the show, gents. Rich, what's going on there? You're in the land of the free.
I'm on Plague Island. Corona, 88,000 cases, baby. We're gonna top 100,000 by the end of this week, and yeah, it was actually quite normal just like 5-6 days ago, which is the sad thing.
As soon as you landed,
it was maybe I'm the one who brought it over here.
And you're also the cause of the Bank of England raising rates today.
That I'm definitely
suddenly.
I called in a favor, and they did it finally after all these years of dithering.
Coincidence? I think not. Keith, what do you think?
Well, Rich must be in the UK right now. Is that wallpaper that's behind you?
It's felt wallpaper. It's even more embarrassing than normal wallpaper. It's actually felt wallpaper. I won't tell my friend I'm at his house. Otherwise, a beautiful house, but this is quite gauche. So.
Oh, I thought you were going to say you were staying at the Fairmont or something swanky.
No, I can't afford it.
So back here up north, we've got a really big week, and I think this is going to be a fantastic podcast because we've got a lot to cover. We've got an update to the Bank of Canada's monetary policy framework, which of course they update every 5 years. So we got an update there. We got an update from our Lord and Savior, the Finance Minister, Chrystia Freeland, who updated the Canadian budget numbers. And then we had, national home statistics coming out for Canada. So like just a whirlwind of a week for data. So kind of want to jump into it. First and foremost, the Bank of Canada updated their monetary policy framework. It's funny, they did like a sort of a side-by-side interview, Tiff Macklem and Chrystia Freeland, kind of showing their marriage joint at the hip there. Basically coming out, and so now they've got they still have the same sort of inflation mandate target, 2%, with a control range of 1% to 3%. But the important sort of addition here is they added in a full employment or a labor component. So but it's funny because they were careful not to call it's not a dual mandate, but they're now considering employment and full employment as a part of the framework of their decision making. And at the same time, they also said that it's hard to judge, it's hard to quantify, quote unquote, full employment. So it was very confusing. I mean, Keith, you've been around a while here. You follow these central bankers. Like, what was your kind of take?
Well, I mean, so first of all, so think about this. You have this really cool job to do. You get a lot of power with it and a lot of financial rewards after you finish the job, really. Then all of a sudden, you're maybe not your boss, but someone who's close to your boss sort of gives you these goals and objectives that can now never be quantified. So
perfect.
Sure, inflation, if it's between 1 and 3, you're okay. If it's over 3, we'll wait for it to come down and try to create some jobs, but it's really hard to measure that as well. I think it's a pretty good job. His job description just changed for the better for him. Of course, which doesn't really mean it's better for everyone else across the country. But we talked about this a couple of weeks, I think. We knew the mandate was going to change. We thought maybe climate change would become the official part of the mandate. But Steve, I don't think that was that discussed directly?
No, they mentioned that they're going to have a role to play, but like they didn't included as part of like their framework. So again, it's kind of like very gray area. I mean, I'm kind of surprised they like left it out, so to speak. But I think the important thing is the labor component, because it adds like this, I don't know if ambiguity is the right word, but like this gray area of just, hey, we're not quite at full. Like, how do you really measure like full employment? Like,
well, can I read the thing? Can I read it?
Yeah.
Yeah.
So it said I'm not going to read the whole thing because that's boring. You guys can all look it up, listeners. But it says it outlines the rub, the little bit that I think is important here. It outlines how we will consider a broader range of labor market indicators to actively seek the level of maximum sustainable employment needed to keep inflation on target. And that's the bit that mentions employment. So that's extremely vague, I would argue. And as you guys kind of nailed a couple of weeks ago, it gives them the cover necessary to do whatever it is they want to do without doing the conceding to the dual mandate. And you guys are being way, way too nice. I know you guys are afraid of getting banned. I think I'm starting to care less and less about that. I think it's outrageous. And then, I wrote to a colleague and I explained my angry tweet. And I think the reason is because timing is everything, right? They're not doing this in 2016 when they're just, if they really cared about this and they, it was really important to how they perceived governing Canada may or may not be, sustainable employment as part of the Bank of Canada's mandate. That might be a really important thing to consider when you're starting to want to go into power. These are the things you want to change as part of Canada's central banking framework. But it's when you've got inflation really high. It's when you've got 10% budget deficit. It's when you have this kicker of the climate change stuff that can make you do all kinds of wacky things in the background. It's when you are already back to full employment. Let's keep that in mind. The peak pre-pandemic peak in employment was 19.2 million people, and now we're at 19.3. Some might say, Rich, some of those numbers are wonky. Fine. Okay, I'll concede that. But we're still very, very close. I think we can all admit. What about unemployment rate? That we're back down to pre-pandemic lows. Okay, let's ignore the unemployment rate. What about participation rate? Same. We're back to pre-pandemic highs. So it's not just they did it today. It's not even necessarily that it's a bad idea. The U.S. has a dual mandate. I would never necessarily, I would have critical of the U.S. central bank for all kinds of reasons, not necessarily that one. It's that it's right when they're supposed to be raising rates and putting the squeeze on the crazy spending. It's that they now have a clear and perfect cover not to. And I think that's the outrage. It's a pattern. So I'm going to I'll step away from the microphone and let you guys take it on. But I think that's the real key issue for me.
Well, I mean, I think that, I think it's important to kind of understand here. Like, I don't know, it's funny that they did this, conference together as well. I mean,
great point.
Yeah, people are calling poor old Tiff Macklem Freeland's lapdog.
And that's the polite way of saying it.
But I mean, Keith, you've talked about it before, but just how, officially, if you read CBC News, the Bank of Canada is independent, but, really kind of behind the curtains, wink, wink, nudge, nudge. They are not really independent. They're kind of working together, obviously, because, Ray Dalio has made a point, whether you like him or not, but you're kind of in what he calls monetary policy 3. So monetary policy 1, you drop rates to basically, zero. You try to re-stimulate the economy through dropping interest rates. Monetary policy 2, he calls, you try to do a bunch of quantitative easing while lowering your interest rates. Okay, well, that's, we've kind of exhausted that. Monetary policy 3 is basically fiscal spending or large deficit spending that ultimately gets financed by the central bank. And that's kind of like the end game, so to speak.
But really well put. The other thing is that always ended in tears, by the way. Let's not forget that. But the other thing is the central bank thus far has given the government of Canada everything they wanted anyways. So it's like, not only have they been, demonstrably not independent. Remember, in 2008, the Bank of Canada bought only 8% of federal debt issuance. That cycle, 2008 to 2011. This time they bought 90%. So clearly there's something going on there with respect to quote unquote independence. The other thing is, it's not enough to say that you're independent. It's that you have to be perceived to be. And I think that's the other thing that I think that they've just totally ignored, right? Them doing the press conference together. I mean, when have you ever seen Kamala Harris and Jerome Powell hanging out together? They're always on different sides of the table. It's meant to be it's meant to be perceived as a somewhat adversarial relationship. And this idea that they're kind of forgetting that, like pushing that aside, to me is a mistake. I think it's, maybe most Canadians don't give a shit about it, but I think it's really important.
Keith, did you want to chime in there? Because I just had a quick little point. I don't know if we touched on it last week, but the Bank of Canada is essentially a crown corporation, right? So it's like, basically you got a situation where the Bank of Canada buys the government debt, and all the interest payments that the Bank of Canada receives from the government actually essentially get remitted back to the federal government. So it's basically just like an accounting trick.
But that happens in the US too, right? The Federal Reserve's largest shareholder is the US Treasury and a bunch of other kind of systemically important banks. And in the years post the GFC, the Federal Reserve handed back, I think at one point, there was one year they gave back like $87 billion in dividend payments. So it's not an unreasonable sort of, what's it called? Arrangement. Just put it in context a little bit.
No, it's a good point, Keith.
Well, one thing that was interesting, Rich, I think you mentioned, you never see Harris and Powell hanging out together. I've never seen Harris and Biden on screen together either. So okay.
She's like you. She's always hanging out. She doesn't leave her house.
Yeah, something like that. I think you hit right on the head, Rich. I mean, you made a comment that they're supposed to. If you're perceived as not being independent, then it is what it is. So from our perspective, I think it's important not to view the Bank of Canada in isolation, because when they went super duper dovish and passive there at the beginning of the pandemic, they were doing exactly what everybody else is doing as well. So on its own, it's like, holy smokes, they're buying, they're funding the entire deficit. The low rate is zero. They're bailing out the banks, bailing out the provinces and all that stuff. But, every central bank was doing that at the same time. And what's really great now with central banks, so especially this week, the Canadians are now, the Americans came out yesterday and they're saying, hey, we're going to be more hawkish. And by the way, we'll go back into this because this is incredibly important what the Fed did yesterday. It's going to have, you have to ignore what happened in the markets over the last 48 hours. Because what the Fed said, it's going to just rip the soul right out of the emerging market world. Then you had the Bank of England this morning. Now they've turned more hawkish. The ECB, which we'll come back to as well. But the Bank of Canada is doing exactly the same as what everyone else is doing. They're all backed into a corner and they're trying to have it both ways. And so it's not shocking. So in isolation, Canada looks pretty bad, but I think if you compare the Canadian situation to Europe, especially, it's pretty good. Like I would be long Canadian versus Euro, for example, like on a cross rate. That's what you'd look at. But again, like all the central banks are doing, pretty abnormal things, but they're all doing it at the same time.
Yeah, so let's expand on that, and then we'll get into sort of the sort of bigger picture global macro, because I think we obviously had some news out of the Fed there in the US, but speaking of the sort of joined at the hip, so we had the Bank of Canada update to their don't call it a dual mandate, but you had Christopher Freeland also came out the same week updating the Canadian government's budget deficit. So They're forecasting a budget deficit of about $144 billion this year. They said that was quote unquote like a slight improvement or a better than expectations. So good job, everybody. But just for context, in 2009, so following the global financial crisis, right? I mean, basically the world was coming to an end, so to speak. The budget deficit that year was just under 35 billion. It was actually 33 billion in that 2009 fiscal year. So this year, again, we're running 144 billion, just for context, right? I mean, that's just a staggering number.
That's twice. By the way, that's as a percentage of GDP. It's twice, effectively.
Yeah. So
right. Twice as big.
Rich, do you have any of the numbers in terms of like fiscal spending as a percentage of GDP right now?
Well, I mean, I can just tell you what. Yeah, so right now it's about 11 according to the IMF, and I that's for 2020, and in 2021, basically, it's meant to go around to 8. That's their sort of forecast for 2021. But no, I think who knows what's going to happen in 2021 and 2022. I don't like to trust the IMF forecast because they're a little bit rosy. But the important point that I wanted to reiterate what you said, Steve, it's in 2008. 9 and let's say 10, I'm trying to see the chart now, it was about 5% of GDP. So it's just to give you the context, I mean, the budget deficit is basically twice as big, right, over those few years. It's wild.
Right. So they're okay. Yeah. So they're basically their own. I guess maybe to sort of make this a little bit more simple for the viewer here that's trying to play along. Essentially, government spending is responsible for roughly 10% of all of GDP in Canada. Is that a fair?
Yeah, it depends, right? It's like, what part of growth, and that's a different calculation. And there's like, there's like the knock-on effects. I mean, the issue is we're spending money. I think the real issue is we're spending a lot of money that we as yet have not figured out a way to fund. And instead of that having a significant impact on our bond yields, right, e.g. the credit worthiness of our nation, it's not because central banks are no longer independent and are squeezing down. So it's just that's a whole, it's not fair to just wrap it up into one sentence, but I think you've done a really, really good job of highlighting the major discrepancy, the major change. So yeah, carry on.
Keith?
So what I love about those those federal financial projections when they come out with it, they always give you a 5-year projection where it's going to go, and then you get, I think it was the OECD numbers that we saw earlier, and they'll go out 10 years, and I always get a great chuckle because so the people preparing these, especially for the federal government, you're preparing it to support what you want to do. So it's like the what's the spreadsheet term, the goal seeking term that we use?
Goal seeking.
I was going to call it kabuki theater.
Kabuki theater.
I don't know. It's a new term I heard. I like it. I enjoy it. So I've taken it.
Okay. So the bottom line is, though, they're trying to figure out, what we're going to have to borrow a lot of money for this spending. And I know we talked last week, and I think I made a comment that, governments are not running a P&L, a profit and loss, so they don't really care. And maybe that they don't care. It's very hard to quantify a subjective goal you're trying to make. So with all these deficits that are being projected, I read through the whole paper yesterday that they came out, and, they're going to improve everyone's life because of COVID. People have losses because of COVID. Everything is, and again, there's, a rational person would agree with everything they're saying. Yeah, of course we got to do this. Yes, we're going to do that. So there's no way to quantify, where we're really going to draw the line in the sand. However, they also show data that show what's going to be the impact of the deficit on GDP over the next 5 years. And what you'll see when you look at that paper, it improves every single year to the point where I think they're almost balanced in 5 years. And I'll bet you Steve Saretsky's mic, they are not going to be balanced in 5 years.
The budget will balance itself.
We're betting your condo, Steve, that the budget will not balance itself.
Oh, no.
Yeah. Balance will budget itself. I like that, by the way. That's pretty cool. And but the other key thing, though, but just to carry on from that, because we're all data guys. We would like the numbers. And as soon as you dig in deeper, and they have a full paragraph there, they're saying. So one of the financial tricks that the Canadian government will always do, and it's always from a political perspective, you always want to compare yourself to somebody else. That's what you do. You think, and that way, then you can make yourself look better. And so in this paper, they're comparing Canada to the G7. So G7 is like the old man's club. They hang out in the library with wallpaper in the room, like what Rich has there right now, where you are. And you can, if you're a member of the G7, you can always yank out, somebody else's statistic on something to make you look better, because we're all horrible. We've been around for so long, spending so much money and so forth. But the key thing with all these metrics, that you look at the interest rate that they're using and the interest rate that they're assuming. And this isn't the Bank of Canada, right? It'll be long-term interest rates. They're effectively making the assumption that long-term rates will never, ever go higher. And it's a market rate. So if rates stay low forever and the economy continues to boom and the Bank of Canada is able to, they don't have to raise rates too much on the short end, inflation is taken care of, but growth is still being maximized. There's a lot of things that don't reconcile here. It's going to be extremely difficult for these long-term projections to play out, because otherwise, 5 years ago, we wouldn't be in this position today. And people say, hey, well, COVID happened. Of course, that is fair. However, if you go 5 years before the previous 5-year projection came out, like none of that happened. And so they keep leapfrogging each other with their projections. And it doesn't matter who's in power here. They're always using unreasonable economic and interest rate data to goal seek what they want to show everyone. And today people think with their left side of the brain so much today that, again, no one is questioning, why aren't you using the right side of your brain? Like, again, where's the money coming from? How are you going to do it? And it's just creating this, I think it's going to be an exceptional market.
But I think that's an important point, because as a government, like what's the old adage? Like, you never let a crisis go to waste, right? And so I think the important thing here is, like, you have to kind of mobilize the people in society. And so basically right now you have to mobilize people to come together for one sort of cause. And what we have today is we are running wartime monetary and fiscal policy. And this time there's no guns, right? It's a virus. And it is you keep hearing politicians, it's the war on COVID. It's the war on COVID. We've got to fight this thing. We've got to end this pandemic and move on. And, we're 2 years into it. And you're still going through rolling lockdowns and third and fourth boosters. And we need to spend more because of COVID. And it's funny because if I look at part of that budget deficit, the Canadian government has pledged nearly $30 billion in new COVID spending over the next 6 years. So they've got spending $30 billion that's spread out over the next 6 years for COVID, right? So again, you have to sort of think almost like a politician, right? I mean, like you need almost like an excuse or a cause to sort of run these massive deficits and get people to support them. And one way to support them is like, we need to do this in order to beat COVID. And like, if you say, well, I don't want to beat COVID, you're like, what kind of human being are you? Right. So it's you've got everybody. And obviously, of course, the mainstream media pushes it, just says, hey, Chrystia Freeland, good for her. She's spending money to fight COVID. She cares. So like, we're doing the right thing, right? Like, $10 a day childcare. Like, what kind of person are you if you say that's a bad policy? I mean, you don't care about children and, equality, it goes on and on and on.
But I agree with you, Stephen. That's why I think it's so important that you never take things, I always say it's never just one thing. Well, you can never just look at one thing either. When people tell you who you are, believe them, And I think that's why when, you see Chrystia Freeland stand up with the Bank of Canada governor in conjunction with the changing of the mandate, in conjunction with the COVID as an excuse to do all kinds of things that these guys have had in their briefs, in their attaché cases for years and years and years, and have been waiting for this opportunity. And the other thing is that they see the forecast. There's a forecast on the numbers side, but there's a forecast on how, a lot of this policy is directly related to why house prices are up like crazy and inflation is up like crazy. And they refuse. So not only are they going to get all the good stuff, but all the bad stuff's not their idea. And it's not about bashing one political party or another, because I can promise you there's loads of right-wing politicians who've done this exact same thing. I think for us, it's just to recognize, as Keith always soberly tells us, who cares, what should happen. It's about what is going to happen. And so that's, for me, when people say, rich inflation is going to correct, I say no. And I cite the previous examples of what we just discussed. And when, and I'm sure when people say, oh, don't worry, our housing policy is going to really help the house prices. Steve, what's your view on all of this on housing?
You gave me a fantastic segue, because we're talking about, obviously all these central bankers coming together with the budget deficit spending, et cetera, et cetera. I was actually, I don't know if I mentioned this podcast last week. So I went and testified in the House of Commons there on the finance committee.
Cool.
They were talking about proposing a bill to, again, fight COVID. And so I just went on there and said, listen, I can't speak about, where you're going to spend these funds. And obviously I think trying to push it towards the hospitality sector, which I'm sure, yes, they probably, especially now with rolling the lockdowns, they're going to need more support and more help. But all I said was, I can't necessarily speak to that, but all I said is you guys might want to be very particular of where you allocate and how much you spend fighting these pushing these programs. Because I said what I can say from my experience is that you might have overstimulated, and we're seeing that show up. This excess capital sloshing around, and in my opinion, it's showing up in house prices. And I kind of just elaborated that, so now if we look today, the same sort of week all this is coming out, we had national home prices. They're actually accelerating. They're inflating at their fastest pace ever on record. So national home prices in November are up 25% on a year-over-year basis. So 25%. This is like a crisis on epic proportions. That's kind of where we are at from the housing market. If I look right now, you've got home prices are rising. They're 2.7% on a month-over-month basis. So it's like we've actually had, if you go back, just remember from the get-go that these guys have been wrong the entire time. Remember a year ago, Tiff Macklem was saying, oh, housing, it's just transitory. It's a little bit of pent-up demand because people were shut down in their homes for 2 months, and this too shall pass. Again, since his comments were up, another 25+%. And he said he came out and said the same thing in the summer, right? He's like, oh, we can see housing is slowing down. And it kind of did. It slowed down a little bit in the summer, and it's re-accelerated since September. So September, I can tell you, in Vancouver and Toronto, it's the two markets I follow the most. From September to where we are now, mid-December, the entry-level detached house is up another 5 to 10% in those 3.5 months. We've basically got I would call it escape velocity. It's unbelievable what's happening right now.
And to add to that, one thing that's really great. And again, I always like to know what our policymakers going to do. And again, the Bank of Canada and the federal government, they're so incredibly consistent all the time. So the Bank of Canada will not do anything to pop the housing bubble. They're not going to do it. They've had so many opportunities already.
Keith,
and to think that
you just crushed all these millennial dreams.
I know, but it's, hey, no, not me. I'm just the messenger. But what's also great is that the federal government, they're not going to do it either. They're going to dance around it. So the housing bubble, it will correct. It will self-correct, by the way, because nothing can, nothing is
nothing grow. You mean trees don't grow to the sky?
Yeah, absolutely. So it will be a market event that will cause it to correct. But if you know it won't be the policymakers, it will be something else, and that's what we keep going back to. Maybe now now that we know what Bank of Canada is going to do, they're going to try to raise rates. Absolutely, they've already ended QE. The Americans are doing the exact same thing. In London this morning, the Bank of England, they surprised everyone and raised rates. The Europeans try to be fluffy about it, and they're not going to raise rates, nor are they ever going to end QE, but they're trying to have it on both sides of it. But again, now the central banks are now set up, the Canadians and the Americans and the Brits anyway, are to try to slowly move back to a normal rate of interest rates or level, and they will do that until something breaks. And of course, what the Americans came out with yesterday, it tells me as an investment manager, again, this is exactly what I wanted to see. They said, hey, we're going to be hawkish. We're actually going to accelerate our pace of slowing down bond purchases. We're absolutely going to start raising rates. And if things do not slow down, or if there's no event anyway, they'll keep doing it. So they'll keep doing this until it stops. And the reason we like this, because it's trending right along the path that we expect it to, in that as the Americans are able to raise rates, raise interest rates, stop their QE or slow it significantly, it just, again, it sucks capital out of the rest of the world. And from our perspective, it just creates opportunity for investment portfolios. So the emerging market world, they're really going to struggle. And I know, Rich, earlier, was it yesterday, Rich, that you compared Canada to Turkey?
Yeah, I did.
You did that? So
yeah, I did.
I was outside yesterday. Yeah, I was outside.
It must have been yesterday or the day before, and I meant it. Obviously, they're massively different countries. Different current account balances, different food, different sports.
Didn't that tweet go viral?
I guess so. As far as I'm concerned, it did. It was a little embarrassing. I've done so much better work in the last 2 years, and for that stupid thing to go absolutely bananas, I guess it hit a nerve, because I think in some ways people, they're constantly being spoon-fed this bullshit, basically, that food inflation is 4% when everyone knows it's 25%. That housing prices are going to come down when at a federal level, when we all know it's provincial and bureaucrats that get in the way, and it's negative real interest rates that are the big lever. People are just, enough of this already. Let's someone, and this is why, we talked about this last time, why this long form media is useful, because someone, I'm not saying we're saviors, but at least we're having an honest discussion about the difficulties that regular people are dealing with, which is housing and inflation and horrible returns on their equity portfolios that will inevitably be a result of the tightening of fiscal policy in the US. But one more thing on that like housing thing. I'm sorry. One more thing. Sorry, on the central bank stuff, where maybe Keith and we disagree. I don't think that raising interest rates, 30 or 40, like 30 basis points. Today was 15 in the UK, 25 basis points. Is the next rate hike expected for the US? 100 basis points is expected for Canada the next 12 months. It doesn't matter. Inflation's 5%. Negative real interest rates are still at 50-year lows. So like all this stuff, all this talk, misses the trick. That's why it's not going to affect housing unless you raise interest rates higher above the rate of inflation, e.g. real interest rates, which, by the way, is what it's been for most of the last 70 years. This is not some kind of crazy Austrian hawkish view. All I'm saying is let's just go back to normal. And I'm pretty sure all the stuff that we bitch about.
But the Bank of Canada, again, like the Bank of Canada is not going to deflate the housing market, because if they do, they deflate the banks. Because there's only 6 big Canadian banks. And if all of a sudden, if the housing market is purposely deflated or corrected, it just cuts the banks off at the kneecaps. So
no, but wait a second,
that's not going to happen.
They weren't during the pandemic. Canadian banks weren't even allowed to pause their dividends because all the old people are relying on their dividend payments.
I know, it's all one tightly wound, like it's like the snake eating its tail, right?
It's the same trade.
But the snake eating the tail, right? Like you keep going around and round. And
Keith, you're way more cynical. You're even more cynical than I am, which is quite impressive. So congratulations on that. But if you raised interest rates by 200 basis points at the front end of the curve, it would still be, you'd still have negative real interest rates. And it would dramatically change the calculus that people make. But I don't necessarily believe that it would tank the housing market. To me, I think that's way, with respect.
I still think if mortgage rates, we've talked about this in the show. I think so long as mortgage rates go north of 3% and they hold for 6 months, I think you'll see a significant slowdown in the housing market.
Yeah, but wait a second. Tanking a housing market to me is, Las Vegas in 2008, 40% decline. Ireland, 30% decline. Spain, projects all over the coast of Spain. When you drive down the coast of Spain, it's just a skeleton made out of cement, and people just basically packed up their tools and went away. The idea that you just don't have 30% year-on-year increases in housing is not a tanking of the housing market. Sorry, can we get some definitions squared away here? Because all I'm saying is if you raise interest rates a little bit, you just might have a 5% increase in house prices instead of
5%. 5% a year would ruin a lot of retirement plans.
Oh my goodness. I mean, am I too naive? Maybe I'm just naive. I don't know.
Keith's pissed.
Uh-oh. Yeah, Keith is just subjective. So the greatest way the Americans can fix their inflation problem, and I think this is the way that they'll fix it, they're going to let the dollar run hot, and they'll let a correction take place in equity markets. And that is one way to slow down inflation. Because if all of a sudden, just say you value your investment portfolio at, let's say it's $1 million or 5 million or 500,000. All of a sudden it's 10, 20, 30% less than what it was last month. You stop spending. You slow down your spending. And if the dollar is stronger, all of a sudden the cost of importing stuff, isn't as much. The Americans have a very unique opportunity that the Canadians don't have, the Australians don't have. And by the way, Europe is absolutely the most dangerous economy on the planet when it comes to fiscal and monetary policy. It's just set up for this unbelievable bang that can take place. I mean, for example, we're talking about, for example, the Bank of Canada was monetizing effectively all of the monthly deficit from Ottawa, right? What if you knew the Bank of Canada was buying 120% of the deficit every month?
Ridiculous.
Yeah. What if it was 150%? And that's what's happening in Europe. So the ECB, they're buying all of the Italian deficit that's being issued every month. Plus, they're buying Italian bonds that are already trading as well. Same thing for Spain and Portugal and so forth. Not for the Germans, though, because it's just the way that the grid is made out. But again, you always have to compare one country to another. Like I said, what the G7, what the Feds do with the G7 metrics, but the same thing on a monetary policy. So as bad as it can sound here in Canada, again, like the big bang that can really affect all the markets, it's going to come from overseas, whether it is Europe or Turkey. And by the way, I know you meant comparing Canada to Turkey is a bit of a tongue in cheek, and the metrics in Canada, Turkey is absolutely horrendous, and Canada is not even remotely close to being a Turkey.
No, it was tongue in cheek.
Yeah.
It was about the government. It wasn't even so much about the economic realities, the numbers. With all due respect to some of the people who got all annoyed about that, it was really just purely the government intervention in the central bank. Leave everything aside. Erdogan put his nephew or whatever it was as the head of the central bank, and I couldn't help but think it was the Canadian, polite, oh shucks, we're just we're above board. We're going to do it in a nice sanitized way. And I'm watching this. I'm just it's just, it's the Middle East. So everything's a bit more obvious, and Canada's very sanitized and white. So, you know what I mean? What are you going to do? Yeah. But thank you for clarifying that.
I didn't want our listener to be confused. That's all.
Good. No, I'm happy you said that. Thank you.
Yeah. Why don't we move along next? Oh, sorry. Go ahead.
No, you go ahead, Keith. I was just going to say to wrap that whole Canada stuff up. I've just been over the last couple of weeks just flabbergasted at what's happening with fiscal monetary, and just that everybody just seems to be asleep at the wheel. Like, and like, there's no media coverage. Nobody ever asks central banks any hard questions. Everybody just nods their head and yeah, okay, you know, same thing
so
now, right?
it's a good
Just
point, 'cause, like, when I-
shut it down,
Yeah.
That's a
everyone's
really good point. It's a really good point.
It's just
So when I
for
go
it.
to, say, dinner parties or hanging out with friends for this or that, nobody I know do they ever talk about Canadian financial metrics. No one. It's not even a part of the conversation. And I don't know if it's because they're just not aware of it, or they don't know where to go to get the information, or so on. But you know, as Canadians, you know, maybe this podcast is a great start. You know, people become more interested and aware of it. But the longer that the majority, and I don't mean like 50 plus 1%, I bet you it's like 90% of Canadians have no idea of the awkward financial position that we've been pushed into right now, and what
go
the
ahead.
ramifications can be a few years from now. Because when it happens, it's going to be how did this happen? And of course,
I don't want people years from now to be like, oh, we didn't know. How did this happen? We're shocked. Or worse, blame the incoming government, because eventually people get sick of whatever party's in power, right? And the new guys are going to come and they're going to be holding this grenade, and then they're going to freaking throw those people under the bus, regardless of your political persuasion. I promise you, if the political parties were diverse, I promise you I would not be saying, my view would not have changed. I can guarantee you. But and the other thing is, people say, oh, Rich, you're such a Canada hater. You all hate on Canada. No, it's because I love Canada that I think people should be informed about the realities and the potential repercussions of this.
Yeah. Speaking of which, I'm not sure if we mentioned this in the show here, but the OECD put out a report highlighting that Canada, of all the advanced economies, is projected over this coming decade is going to be the worst performing advanced economy in terms of real GDP per capita growth. So again, if that doesn't piss you off as a Canadian.
Hey, Steve, tell everyone who was number one on the list for the best growth opportunities. I think it was. Oh, God, I didn't even look to the left on the bar.
How did that happen? Turkey.
It's Turkey.
Real.
But again, it just shows like it's a one-dimensional metric, you know? Like,
yeah.
Yeah. And that's the challenge here, of course.
And you always have to take these forecasts with a bit of grain of salt, to be fair.
But I just see these and I get like emotionally charged. I'm like, man, we are run by a bunch of idiots. But anyways,
I'll tell you one of the ways that these are calculated and why Canada does so badly is because the if you look at, remember, it's something Reinhardt and Rogoff, who are these really very, very well accredited IMF researchers. They went to Harvard and Yale, and their children are in Harvard and Yale, and their grandparents everyone went to Harvard and Yale, whatever it is. And they basically argue that the more debt that you have in an economy, the much, 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 much harder it is to continue to grow at whatever pace. So ultimately, I haven't seen this OECD study that well, but I've seen enough of these studies to know that a lot of them are a function of when you have that much debt in your economy. And Canada is, the Bank of the Canadian finance minister couldn't answer this question, but Canada has 345% of debt to GDP, right? And our household debt to GDP is one of the, we're in the top 5 of household debt to GDP, government debt to GDP, non-financial corporate sector debt to GDP. So we've got a lot of debt. And the only way you can really grow out of that is you either inflate your way, you do productivity, or, there's a couple, or you default. But anyway, sorry,
just to quickly touch on that, but that's what I think. You see all those metrics, you're like, holy shit, this thing is like an absolute debt bomb. Just wait, it's just this powder keg, just ready to blow. And then you hear like these, the big bank economists that come out in Canada and say, oh, 8 rate hikes. It's like, is this just like a belief and a faith in the system? Because there's no way when you look at all these debt to GDP metrics and the amount of leverage in the Canadian economy that you can actually get away with that many hikes without completely blowing up the local economy here. It's like, did these guys just look past that? I'm just kind of curious of what are we looking at here?
Yeah, that they do, Steve. So for example, that the OECD data points that you're showing there with, Turkey as being the projected to have the most success, with Canada with the least amount. All of these are based upon, so for any debt metric, as long as you're able to borrow, to roll over the maturing debt and to borrow from more debt, you become levered and become levered, you get a dollar of income, it could become 3 or 4 times. So that's why these emerging market countries, they always look awesome when things are going well. But the moment a crisis hits, and this is where the big banks, they always have a challenge because they're never going to forecast a crisis to occur. It's just not in the culture. You're not allowed to do it. And everyone misses them, of course. And it's one thing to say, hey, a crisis is going to happen. People say, well, when is it going to happen? They have that sort of backhanded slap on you for even suggesting it. But when they do happen, and they do happen on a regular basis, Turkey will implode, as it's happening right now. The Asian countries imploded back in the late 90s. It's not because they had too much debt. They couldn't borrow. Foreign investors said, whoa, you're in trouble. I don't know if you are or not, but I heard you are. I am not giving you my money. And it just leaves the system, right? That's what happened. And that's where we are today. It's like something will go bang or boom in the night, whatever the phrase is, and that's when it's going to really mix up these numbers. So what's really interesting. So in the financial planning world, one of the biggest suggestions or recommendations you read in all the books and TV shows and podcasts is pay off your debt first and all that stuff. Yet for some reason that doesn't exist for the public sector. I don't know why, but it doesn't. So,
can I just add one more thing to the crisis thing? So, one of the reasons the Asian crisis, and it relates to Canada, but one of the reasons the Asian economies, when something did go wrong, they couldn't borrow. But if you step back a couple of years before that, it's because they were running huge budget deficits, right? So they weren't building reserves, right? So now if there was something wrong, those exact same Asian countries, they've been building massive reserves because they were forced to change their economies. It hurt. They had a massive external devaluation of their currencies, and then all those current account deficits went to current account surpluses, and then they used that consistent current account surplus to build up massive reserves. So if something happens, they can draw down on those reserves and meet their near-term obligations. Basically, they're not insolvent. They can deal with liquidity crisis. The reason why Turkey is so screwed is because, for one of the reasons, I mean, I'm not as sophisticated on Turkey as maybe I should be, but they run current account deficits. They don't have any of those reserves. They have no sort of shock absorber. I always bug my friends who are, very into all this climate change stuff and green stuff, be careful. Canadians should be very, very wary of knocking down the oil sector, because the only thing that is preventing Canada from becoming one of those Asian countries of the late 90s that is extraordinarily vulnerable to external shocks is the fact that we have a massive current account surplus in oil. If tomorrow that went to zero, our current account balance would be severely negative. We would have no reserves very, very quickly and would be extremely vulnerable to those external shocks. So I'm just I know that's my bugbear. Maybe I should stop talking about oil because I know it's probably a bit much for a lot of people, but just be careful what you wish for is what I'm trying to say.
Rich had a really good chart on that. Was it yesterday or this morning or the day before?
Yeah, it might have been yesterday. Yeah.
Yeah. Maybe we can share that one on the show.
I think
today.
we posted that one before, but we'll post it up again.
There's another version of it.
Oil basically pays for our way of life, basically.
Yeah, it's a great chart. So why don't we move on to? I have a couple of. When I was in before IceCap, I was working on a big desk. There's a bunch of us there, and at the end of each year, we used to play the "If You Knew" game. That's what we would call it. And it would go something like, if you knew the economy would grow at this rate, what do you think would have happened with this market and that market? And what you've always discovered with that is, and it's a good point I think people need to appreciate, is that most times financial markets are not reconciled with the economy that you're in. Or you can have economic movements and booms and busts, and financial markets are doing the exact opposite, or they have no correlation whatsoever. So like a couple that I just saw there a couple of days ago, I thought was interesting. So if you knew a year ago that inflation will be running at 6, 7, 8% on an annualized rate, what would have you done? And of course, some say, I would have loaded up on gold. You kidding me? We go from 0% inflation or deflation to 6-8%. I'm going to make a killing on gold. And what's happened with gold over the last year?
It's down.
It's a negative. Yeah, you've lost money. Or another one, for example.
Keith, we're going to lose all our followers. Careful.
Well, here's another one. If you thought, again, inflation will be running at 6 or 8%, and you're already loaded up on gold, you don't have any more room for that. So what else are you going to do? You're going to short the bond market. You're going to short the 10-year. What's happened? The 10-year, it's been pretty flattish over that time. So again, it should, as an investment manager, it's something to think about all the time. Just because we're suggesting the economy is going to do this or that, it's not always a one for one move in another corresponding financial market or investment market. It's really important to remember that, everyone. Yeah.
Buy the dip on housing.
That's my lecture. It's my lecture, right? Just buy a house and sit on it. That's all you need to do.
Steve, can I ask you a question? If we can circle back. Sorry, I know this is a bit naughty, but I have just a question. I'm really curious, and maybe some of the listeners are too. Like, when they were asking you questions, like, were they smart questions? Like, did you feel like these people were switched on and they knew what they were doing and genuinely trying to get at the answer, or were they just trying to cover their butts?
I mean, it's kind of funny, right? Because like I went on there and I found out, obviously, I found out when I got on to the show that I was invited on by like one of the Conservative Party members. And so I was, and then the Liberals had invited on their sort of lapdog, and the NDP had invited on sort of their, person that aligns with their political party, so to speak. And so like most of the questions that were fielded to me over a 2-hour period were largely from the Conservatives. I think I had 0 questions from the NDP about housing inflation.
You'd think they care anyway.
No, they don't. Yeah, it's just like they don't get it, right? I mean, and then I had like one question from like the Liberal Party. But yeah, I mean, so keep in mind that majority of my questions were from Conservatives, who I think were ultimately as well trying to play up like kind of what they're playing up now, which is like just inflation and like that. But I mean, again, I think they are bringing up some important points, right? I mean, like the Liberals are sort of supposed to be this like middle class advocates. You remember when they had a minister of the middle class, which they had to fire or get rid of because they couldn't define middle class because, well, middle class doesn't exist. Newsflash. Like when you have national home prices running up 25% year over year, like just devastating for that middle class.
Steve,
lower middle class.
Steve, I'm just curious, what were the questions from the other side? Like not to you, but to the other invited guests. What were they being asked?
Yeah, they like, it was basically like, so for the NDP they had brought on some lady. I mean, she was nice. I don't remember her name, but she was more or less talking about the CERB, and the government was trying to claw back CERB payments from sort of like retirees or low income individuals that had maybe had received too many CERB payments, and the government was trying to claw some of that back. And she was saying, well, like they can't afford to pay it back. Like you need to just give them an exemption, call it a wash. So that was like one of them. And then the guest, I think on the Liberal side, was she was kind of like a lobbyist for the hotel sector. Trying to, obviously she was lobbying for more stimulus and more sort of an extension of all these wage subsidies. So everyone was just kind of brought on to sort of angle their political views. And like Keith, like you said, we talked about it before I jumped on that thing. It is really ultimately like a dog and pony show, right? Like it doesn't matter what you say. Everyone's there just to sort of look good, and the bill is going to pass as it passes, and nothing's going to change. We're still going to run these massive deficits. We're still going to have central bank financed, deficit spending. Like we're just going down this path that like, it doesn't matter almost really who's in power. In my opinion, it's just what it is. And we have to sort of adapt to that environment.
So don't sell your house.
Well, I mean, it's the same thing we were talking about at the beginning of the show, right? It's the same thing with like this COVID stuff. I mean, it doesn't matter if it's a less potent variant in terms of whatever. Like it doesn't matter. All is that like whether you agree with it or disagree with it, if cases go up, lockdowns are coming. Like it's just like the reaction function. Again, you can agree with the lockdowns or disagree with them, but cases spike, it's get your booster, we're locking you down, and it's just going to be this repeat cycle. It is what it is.
I mean, so we're seeing that here now in Nova Scotia. I know that the universities, I think it was 3 days ago or 2 days ago, in the middle of the day after the first round of exams were written, like in the morning session, I guess, and they said, hey, we're now closed for the winter. All exams that haven't been written yet, then we pushed to January. See you later. That was done. Now restaurants and gatherings, that's been restricted again. So you're starting to see, for example, we were supposed to go out for dinner last night and to a restaurant with some friends, and we ended up canceling in the end. Not a fear of, getting sick. It's just a fear that we know the way policies are put together, that if we ended up being exposed at the restaurant, then like one group of friends, they were supposed to travel over the holidays. They knew that, hey, they probably wouldn't be able to do the travel. So these things, I mean, they're not positive for economic growth. And again, it's all about, we know what the reaction is going to be, because we talked about it last week, how it's sweeping across Europe. And now it's here in Canada and Nova Scotia. And what did you say about Toronto? Is this happening in Toronto?
Yeah,
as well,
like Toronto, they've cut. So any indoor event over 1,000 people, apparently they've cut it to 50% capacity. So AKA, if you're going to Toronto Maple Leafs game with 20,000 fans, that's now been cut to 10,000, which is kind of a shit show, because apparently people are like, well, I've got tickets for next week's game. Like who are they deciding that gets to go? Like, are they just going to
Who wants to watch the Toronto Maple Leafs? I'm sorry, I'm confused about this.
Is it the first 10,000 people that show up at the gate to get in, and then they just refund everyone else's tickets? Like, it's just a total mess. But again, it is what it is. And so, like, as Keith said, I mean, that doesn't seem very positive for economic growth. I mean, we're seeing all of these companies, right? Like corporations, all the big banks, for example, like they don't want to take any liability or responsibility. So they're telling, okay, we're pushing our plans back for coming back to the office. Everybody go work from home. And, again, obviously now so this is kind of happening at the same time we're seemingly pushing ahead with interest rate hikes into what I suspect will be a slowing economy in the year ahead. But I mean, Keith,
before I go on a crazy rant about COVID, I'll avoid doing that. But I will just say it's endemic. Like this is it. COVID is never going away. That's all. I will restrain myself and keep my peace to that. I think the sooner we all sort of come to terms with that, I think the sooner.
It's pretty wild though, right? Because like, I'll give you another quick example. I was reading a story. So like the Calgary Flames, right? Like, God bless Alberta. A bunch of their games were postponed because they got all these players like in COVID protocol testing positive. So they can't even ice a roster, right? And so people are coming out and saying, oh, these guys, they weren't vaccinated.
They were.
And they were. And so Milan Lucic came out on the Calgary Flames there, and he says, listen, like, everyone on our team's double vaccinated. He's like, I'm triple vaccinated. I got a booster. He's got 3 shots. And he's tested positive. He's in COVID protocol. Can't play. So, like, it doesn't matter. I just think it's like you said, Rich, like, you got a 4th shot and the variant comes along and, it's not covered by the 4th. So it is an endemic. I don't know. It is what it is, but
there's just no one's. Anyway, I don't want to get into it. I'm gonna get in trouble, but I'm just saying it's here to stay. This is it for the rest of our lives. Almost certainly COVID will be around. So it's really more about the jurisdictional responsibilities that people have to deal with, and how much abuse they're going to be willing to take with respect to their hotel business or their children's education or their travel plans. Be interesting.
Yeah, I'm supposed to go to Palm Springs over the holidays here to record the Looney Hour, but again, I don't know. Like, is it one of those ones where they're saying non-essential travel, and it's like, I don't know. I mean, is it essential to go see your family that you haven't seen for a very long time for you can call it what you want, mental health reasons? I mean, it's
So let's, to circle it back to the whole, the investment world. Again, this is from our perspective here. if we know that policymakers across, say, Canada and Europe and Australia and everywhere else are going, they've been very consistent. There's no political party or a group to say, hey, this isn't right. Let's rethink this. We know that growth is going to continue to start and stop and start and pause and all that stuff. So the US has a very unique situation coming up, of course, because they have their midterm elections next year. And, no matter which way you look at it, half the country, they believe in one side of the lockdowns, the other half does not. So therefore, you're going to have like roughly the biggest or second biggest economic engine in the world is going to be growing faster than Canada, Europe, a lot of Asia and so forth. So then it goes back to, again, we can see the US just sucking up so much foreign capital, running into it. Plus, if they have higher rates in the US than anywhere else, you get paid for parking money there as well. And again, so we always tie everything together. That's the way we view it.
Is the U.S. though almost not like forced to provide, like, because they are the kind of the liquidity provider of the entire world? So like
they run twin deficits. So they have a huge current account deficit and they have a huge budget balance or budget deficit. And so yeah, in theory they export money, but Keith's right in the sense that if you are the marginal consumer of assets and you want to buy, companies like on the Russell 2000, right, small cap stocks that won't be affected by lockdowns, that have a clear vision on revenue and stuff like that, people are going to gobble up those.
No, I agree on that aspect. I'm just thinking, yeah, if the U.S. starts hiking rates, and you almost basically force every other major or other emerging markets to basically hike rates too, into slowing growth.
Yeah, I mean, so first of all, with the Americans starting to tighten or hike rates and all that stuff, again, it just sucks money out of the rest of the world, and that's fact. That's what will happen. But just say you're here in Canada and you're thinking, oh man, we don't want to crush the housing market. We want to keep spending. The energy market is going to get a few negative winds up against it here coming up. What can we do to sort of sell other stuff to the world? You devalue the currency. The same thing with the Europeans. Because again, the metrics across Europe and Eurozone are just horrible. They need the euro to go down to par. They needed to go back to 80 cents or whatever it was. By the way, I was traveling in Italy when euro was around 88 cents to the dollar. I think it was at the exact low. I think it was 2001. We were over in Italy at the time. That was a good trip too. So, but
one thing being negative, it's one thing being negative euro area, like economic growth, but there's some great stocks there. So I don't know, just, you're more negative on Europe than I am, but I mean, LVMH has performed it just in line with Amazon over the last 5 years, which is something that I think people just don't recognize. So it's one thing to hate the countries and hate the economy, but some of those stocks are.
Well, you have to separate this. I mean, again, like when a country goes into crisis, the stock market usually goes up because people are running. They'd rather put the money in the private sector. So if you go back to Turkey right now, the local Turkey market, it's going vertical. It's going up, up and up. Of course, it's just locals putting the money in the market. The central bank is probably buying it as well to prop it up. But yeah, you can clearly see a situation where, the Eurozone goes into crisis, from a debt perspective. They're unable to borrow, and they can't borrow now really. The ECB buying everything. The currency goes down, and yeah, you can see the equities go up. So if any investor is looking to do those kinds of investments, you want to make sure you hedge the currency side of it.
That's
really good opportunities.
And that is what IceCap's for. IceCap Asset Management. We'll wrap it up there.
What about Acorn Macro Consulting? Don't forget about
with the Tom Brady of macro, as eloquently put by one of our listeners, Rich Diaz with Acorn. Rich, we might be working, or you might be working more or less on a retail product. Anyways, long story short, not to spill the beans here, but we will have a Loonie Hour website. Hopefully launch in the new year. We're going to have some content that gets put up there and to go along with these shows. And Rich is kind of the genius behind a lot of that and a lot of the charts. So appreciate Rich, all your hard work there. We got one more show here before the new year.
Christmas special.
The Christmas special. Keith's going to be wearing his.
I have a Christmas sweater. I have a good Christmas sweater to wear. Ugly Christmas sweater for next.
There you go.
Thursday.
All right, gents. Well, as always, it's been a splice. We'll see you next week for episode 11.